Welcome to my Accounting 1110 review for final. This pencast covers Chapter 2. Again, there are two ways that you can approach studying for this. The first one should be to watch this pencast, because this pencast will cover the important topics and theory that we learned in Chapter 2, and then complete the review for final assignments for Chapter 2 that you can find on my Accounting Lab or on the review for final sheet. We suggest that you complete these assignments by hand and then enter them into my Accounting Lab and let it grade them for you, or just complete them by hand and submit 3 times on my Accounting Lab and see the answers. The final is by hand, and so practice accounting by hand. That only makes good sense. I'd like to review a little bit for Chapter 1. I want to bring a topic forward that I think is going to help us with the review for Chapter 2. And the biggest topic really for me in Accounting 1110 in Chapter 1 was the idea of the balance sheet equation. The assets would equal liabilities plus owner's equity. And in Chapter 1, you learned to record transactions in such a way that the balance sheet equation always stayed in balance. There were only 4 possibilities, as you recall. If you're going to stay in balance, this side can get bigger, and something on this side needs to get bigger. This side can get smaller, and this side can get smaller. And in both cases, mathematically, each side still equals each other. A third possibility is something on the left-hand side can get bigger, and something on the left-hand side can get smaller, and it still equals because they net out to nothing, and you're still in balance. And finally, the last possibility is something on the right-hand side can get bigger, while something else gets smaller. And again, they would net out to be nothing, and you would still be in balance if you were in balance to start with. Well, in Chapter 2, we're going to lose the worksheet because it's not an efficient way to do accounting and move to a real accounting system. But we need to accomplish this while keeping the balance sheet equation in balance. So we need to have the balance sheet equation stay in balance, but we don't really want to do it in a worksheet format. And we're going to learn to do that by recording transactions in the double entry method of accounting. I'll write that here. It's called the double entry method. And what it means is you record transactions in debit to credit format. And in order for us to make the leap from Chapter 1 to Chapter 2, we need to know that if we record transactions in debit-credit format, that the balance sheet equation will always stay in balance. We learn the first 3 steps of the accounting cycle in this chapter. The first 3 steps are covered in great detail in Chapter 2. Then we add a few more steps in Chapter 3, and finally finish learning the accounting cycle in Chapter 4. And this is a key idea. And what we're going to learn to do in Chapter 2 is to record transactions not on a worksheet, but in the general journal. And once you record a transaction in the general journal, you will do it in debit-credit format. It's called journalizing. So what happens is, as transactions occur during the month, you record them in the general journal in chronological order. At the end of the month, or really any time during the month, you need to post each of those transactions into something called the general ledger. And the general ledger, as you'll recall from moving through our chapter, was a place where we list every single financial statement account, all assets, assets, all liabilities, and all types of owner's equity have an account in the general ledger. We record transactions in the general ledger, and then we balance the accounts at the end of the month. And then we transfer those balances to an unadjusted trial balance. And these are all making more sense to you now than they did when we first learned how to do this, because of course you've had a lot of practice. You learn accounting by doing. So you journalize chronological order during the month, then you post to the general ledger, then you total those balances and you list them on the unadjusted trial balance. And when you get through, if everything went right, debits will equal credits. And you'll know that the journalizing and the posting ended up with you being in balance. You can't say there couldn't be a mistake, because you could put something in the wrong account. But it's a really good start. And we'll learn accounting techniques later on that show us how to make sure the balances in each of those accounts are right. So, really what we need to do first is talk a little bit about how the rules of journalizing. Accounting. Now remember, we need to keep our balance sheet equation in balance. And so when we get through with using our debits and credits, we need to have our balance sheet, our adjusted trial balance. And we want to accomplish this by using debits and credits. So let's take a look at how recording things in debit and credit format might leave us in balance with our accounting equation. Luca Pacioli, the father of accounting, he was a Franciscan, by the way, so he really was a father, invented this system. And he said, for no reason known to me, that debits were going to increase the asset side and that credits are going to increase let's go with another way. Debits are going to increase the left-hand side, and credits were going to increase the right-hand side. And if you were going to decrease the left-hand side, you would credit it. That would make it smaller. Your debits need to equal your credits. So if you decrease anything on the right-hand side, it will make the balance smaller. If you debit the balances, it will make it smaller. If you have an account that gets increased on the left-hand side and an account that gets decreased on the left-hand side, they net to nothing and you're still in balance. And concerning the right-hand side, if you have an account that gets debited and an account that gets credited, a debit will decrease the overall right-hand side and a credit will increase the overall right-hand side. Look at that, I made it backwards. Let's reverse my little arrows. A debit will decrease the right-hand side and a credit will increase the right-hand side. That's pretty funny. All these years in accounting and I do that one backwards. So let's take a look at it. The debits and credits of it. Assets are increased with debits, decreased with credits, and if you debit and credit different assets, there will be no change to the left-hand side. The right-hand side of the balance sheet equation is increased with credits and decreased with debits. If you decrease one account on the right-hand side and increase another, it will net to zero and you'll still be in balance. Let's continue this discussion, but let's add in the expanded accounting equation. You have capital, you have revenue, you have withdrawals or draws, and you have expenses. So owner's equity has 4 types of accounts in it. It has capital and revenue, withdrawals and expenses. When an owner makes a deposit into their capital account, it makes owner's equity bigger. When an owner earns revenue, it makes owner's equity bigger. Both of these accounts have credit balances, and they get bigger when you credit them. But two kinds of owner's equity accounts make owner's equity smaller: draws and expenses. When the owner withdraws money, the total of owner's equity gets smaller. So draws have a debit balance because as the drawing account itself gets bigger, it's making the right-hand side category owner's equity smaller. And the same with expenses. To make an expense bigger, you would debit it, and that would make the expense bigger. And as the expense gets bigger, it decreases owner's equity because expenses getting bigger would drop owner's equity. So the rules apply equally as well to the four divisions of owner's equity as they do to the right-hand side in general. You want to make it bigger, credit it. You want to make the total owner's equity smaller, debit it. Making withdrawals and expenses bigger does make those accounts bigger, but by their very nature, they make owner's equity smaller. That's an answer, a real answer, that I think you can learn and forever understand: the accounting equation. Some people like to memorize things. MEMOR, couldn't spell it there, so I'll give you a memory technique too. Assets, withdrawals, and expenses all have debit balances, and they're increased with debits, and you can remember that by remembering it leaves you in awe. Liabilities, capital, and expense or revenue, all are increased with credit balances and have normal credit balances. And after you study this long enough, it'll leave you wanting liquor. So things that are increased with debits leave you in awe, and things that are increased with credits leave you wanting liquor, or maybe not, LCR, licorice, you pick. So that's one way to memorize your way through how different accounts will respond to the accounting cycle, or respond to journalizing in the accounting cycle. Bringing that forward and using only one memory technique, this side is increased with debits and this side is increased with credits. So you know the opposite would decrease it. Assets getting bigger are debited. You have four categories here: capital, revenue, expense, and liabilities. You want to increase capital, you credit it, and that would hold true. You can see credits make this side bigger. Increase revenue with a credit, and that would make the total owner's equity bigger. Increase an expense with a debit, and that would make owner's equity smaller because debits reduce that side. And we need to put draws here. Withdrawals are debited, and when you make a withdrawal bigger, it makes owner's equity smaller because debiting owner's equity makes it smaller. So there you go, the rules of debit and credit. So we leave Chapter 2 with an accounting cycle begun. You record things in the general journal. That's called journalizing. At the end of the accounting period, you post to something called the general ledger. Those are all financial statement accounts are kept, and you prove equality of your posting by preparing an unadjusted trial balance, which proves your debits equal your credits, and if your debits equal your credits, your balance sheet equation will be in balance. So we learn the rules of journalizing by looking at debits and credits. Let's talk just a little bit about accounts. Accounts Each financial statement has one. We usually use T accounts to draw them. I'm going to say cash. Every financial statement account has its own T account. Debits are recorded as always on the left-hand side. Credits are recorded as always on the right-hand side. To debit an account doesn't mean to increase or decrease it. It just means to place a number on the debit side of the account. To credit an account doesn't mean to increase or decrease it. It depends on which account, doesn't it? But it does mean to put it on the credit side. And to balance an account means add up the debits, add up the credits, subtract one from the other. If the debits are bigger, let's add another one. We have 2 debits to this account and 1 credit. Debits equal 300, credits equal 50. 300 minus 50. Debits are bigger, so it has a debit balance of 250. So you journalize according to the rules of debits and credits. You post debits as debits in the accounts and credits as credits. At the end of the month, you total them, and then you prepare the unadjusted trial balance. So our accounting cycle, let's write this right above this, is now 3 steps big. I guess it depends on how what you're going to call a step. You analyze the transaction and journalize it in the general journal. You post the debits into the general ledger and the credits into the general ledger. You total those accounts and you prepare an unadjusted trial balance. That's where the big part of Chapter 2 comes in. There's also some new accounts that you learn. And there's one in particular that I want to talk about, one that causes us the most grief, and that's unearned revenue. The concept of unearned revenue is that you get paid in advance of performing services. So you get some cash. Cash gets bigger, so it's debited. And then you owe someone those services. So we set up a new liability account called unearned revenue, and we record it as a liability. The reason being, you owe them $10,000 or $10,000 in some kind of a service. So as you make your way through Chapter 2 and learn new accounts, pay particular attention to unearned revenue. We'll learn how to move some out of unearned revenue and into earned revenue in Chapter 3. Thanks for joining me for this Pinkcast. I now invite you to go to the exercises at the end of Chapter 2 and complete them. There's an exercise on learning what new accounts we learned. There's an exercise on vocabulary, because learning accounting is always tricky. And then there's an exercise on performing the steps of the accounting cycle, all 3. Journalizing a few transactions, posting them into the general ledger, and preparing an unadjusted trial balance. If you can do these things at the end of Chapter 2, you have conquered what you need to know from this chapter. Let's move on to Chapter 3.